Japan became the last country in the world to shed negative interest rate policy on March 19, 2024. With the latest increase in interest rate, Japan has not only hiked the interest rate for the first time in the last 17 years, but also led to the fall of the long-standing guiding philosophy of Kurodanomics, the aim of which was to spur the economy, to pull Japan out of economic stagnation and from protracted phase of deflation and stagnation. But what exactly is Kurodanomics and why Japan pivoted Kurodanomics after 17 years? To understand that, we need to go back to the past. Interestingly, Japan growth was more than the US between 1960 and 1980s, and it grappled with an unprecedented period of economic lull, deflation and low growth due to stock market crash of 1989, the burst of the bubble economy which had scarring effect in 1990s, the rapid decrease and aging of the population that no advanced economies had experienced. And this all combined exerted tremendously negative pressure onto Japan's economic growth and inflation. According to Bloomberg, inflation was negative between 1999 to 2005, and it was in 1999 when the zero interest rate policy was first initiated by the Bank of Japan. Since then, short-term policy rates have been extremely low, whether it was zero, near zero or slightly negative. The rates went back to near zero level again after the global financial crisis. The man behind the philosophy of Kurodanomics was the 31st governor of the Bank of Japan, Haruhiko Kuroda, who, after taking over as a governor in March 2013, tried to fix the Japanese economy by embracing quantitative and qualitative easing with a negative interest rate policy. Negative interest rates are used by central banks as a monetary policy to stimulate economic growth and combat deflation. The policy results in charges being imposed on commercial banks and financial institutions for holding large reserves. In turn, banks were encouraged to spend and lend money into the economy rather than saving it. That in turn spur the growth and leads to inflation. This is how the era of Kurodanomics has come to an end. But why now? The main driver of this fundamental policy change was obviously strong result of the annual springtime wage negotiations known as Shunto, revealed just a few days before the policy meeting. The Apex Bank of Japan dubbed Shunto as one of the primary reasons for shedding the negative interest rate policy in March. In Japanese parlance, Shunto came into picture 70 years ago. Simply means labor offensive, which means every spring season, labor management negotiations take place between trade unions and companies to decide the wages and bonuses for the coming fiscal year. With this, the Bank of Japan in its latest monetary policy meeting decided to increase short-term interest rates to 0 to 0.1% in a positive territory after a gap of 17 years. But this key change in monetary policy stance will solve Japan's trouble, or the real problem will persist. For this, we need to see the impact going forward.